Hello and welcome. I'm Adam Camillo from Associate Global Partners, and today I have the pleasure of speaking with Jason Teh, who's the Chief Investment Officer and founder of Vertium Asset Management. Jason, thanks for your time today.
Thank you.
First question, for those who aren't familiar with Vertium, can you tell us a little bit about the company and what led you to found it back in 2017?
Yeah, look, I've been managing an equity income strategy for the last 15 years, and in 2017, we launched Vertium to actually meet a void that's in the market associated with retirement strategies. And pleasingly, recently we won the 2023 Financial Standard Australian Equities Income Focus Fund. So, it's taken a while to get to where we are today, but we are being increasingly recognised as the preeminent equity income strategy for the market.
That's great. And can you tell us a little bit about what you think is different about your strategy compared to others in the market?
Yeah, so the Vertium Equity Income Fund is actually designed to meet the unique needs for retirees and conservative investors. So when you think about these unique needs, retirees need to manage income, they need to manage volatility, and yes, of course, over the long term, they still want the potential capital growth, right? But these three needs are very different from your traditional funds where they're just aiming for total return. Hence the fund has inbuilt objectives to meet these three needs to actually deliver more consistent risk-adjusted returns for clients.
And can you expand a little bit more on that in terms of the objectives inside the fund and how the fund actually works for investors, especially those pre-retirees or retirees, as you mentioned?
Yeah, so the fund is structured to meet all these needs in a more consistent way. So for example, from the income perspective, we do obviously invest in stocks for dividends, but beyond that, we actually sell options as an alternative way to generate further income for the portfolio. So the income perspective, is coming from multiple income sources, which means that it can provide a more consistent income profile through time. From a volatility perspective, we also have a margin of safety approach, but beyond that, we have a volatility control process where we actually measure what we term portfolio beta, in terms of manage that profile to be lower than the market. So in any market circumstance, our portfolio should always have a lower risk profile versus what the market is doing. And of course, over the long term, if we're picking good stocks, obviously at low valuations versus the fundamentals, we should provide that long-term capital growth as well.
That's great. Can you share a little bit more about your investment philosophy and what it's achieved for investors in the past?
Yeah, our investment philosophy is based on us looking for disconnects in company fundamentals. We all understand that high quality stocks are more richly priced and low quality stocks are cheaper. The question is whether they're disconnected from those fundamentals, and that's how we add value. If we can identify these stocks well in terms of these disconnects, we can actually deliver a high level of risk-adjusted returns for clients. So for example, we have a term internally where we call neglected orphans or bathwater babies. So a neglected orphan is one where we believe the market has underestimated the company's earnings potential. So, and the classic situation right now that's in the portfolio is an investment we have in QBE. So QBE over the last couple of years, since 2019, has grown their return on equity by 50%, right? The stock is actually trading at a discount to where it was in 2019. So back then it was trading on 15 times multiple, and today it's trading on 10 times multiple. So obviously the stock on a PE multiple is cheaper, but it is on a higher ROE. So the market's not fully factoring in its improvement in fundamentals, so that's why we like it. And on the flip side is that we'll also look for companies that's fallen out of bed. And where we think the market has overreacted to its fundamentals. And 6 months ago, we built a large position in James Hardie when the market was focused on, especially in the short term, on the pressure on high mortgage rates, on the impact on the building industry. What we noticed was that the US home builders were rallying on the prospect of improving foot traffic, and James Hardie was being left behind. So we built a position where the market was just overly negative on the short-term news, and obviously that's played out well because the stock has re-rated.
That's really interesting, and a couple of points that you mentioned around sort of volatility and market sentiment. Obviously, the last 12 months especially has been incredibly challenging for investors more broadly. Term deposits have obviously skyrocketed as the RBA raised the cash rate to fight inflation. What do you think that means for income investors from your perspective?
Yeah, so look, I think the income investors are at the crossroads right now. So they're sport for choice, right? So you look at the term deposit today, it's offering around 5%, right? A year ago, it was close to 1%. So yes, it is actually that the safety of the capital associated with term deposits is actually luring a lot of investors into term deposits, as opposed to equities, where if you look at it through time, consistently it's around 4.5%. So in fact, over the last decade, it's been a no-brainer from an equities point of view. If you're going to drive income, yeah, you stick with Aussie equities. But today, it's actually on par, right? So the real critical question today is, should we dump Aussie equities? Should investors move away from Aussie equities and go into term deposits? And the one thing I want to highlight for investors is just to realize that there are differences when we sort of compare these headline yields. So first of all, Aussie equities come with imputation credits. Unlike many other, equity asset classes, Aussie equities provide an extra level of return. So if we want to compare pre-tax yield, let's say 5% from term deposits, well, we should add back roughly about 1.5% extra return coming from Aussie equities. So hence the 4.5 headline yield from Aussie equities is potentially 6. Right, so Aussie equities, once you add back imputation credits, still provide a superior yield. The second point I want investors to understand is that term deposits income, it is what it is for the next 12 months, right? Because you lock it away, right? But it is not a forever thing, right? So the volatility associated with term deposits income is actually more volatile than the volatility associated with equities. So yes, rates have gone up a lot over the last year, and it's actually quite high versus historical standards, but that could easily fall as well. So if there's a hint of a recession around the corner, that could be cut aggressively, and if that does cut, well, guess what happens, to the cash flows associated with that? That'll disappear. While through time, over the last 30 years, Aussie equities has provided a more consistent 4.5% income yield to investors. And the last point I want to sort of highlight from an income perspective, yes, there could be a case one day where a term deposit rate could be higher than Aussie equities. But the one thing term deposits can't provide is income growth, right? So you do have that security associated with term deposits in terms of your capital base, and equities, yes, it's a bit more volatile from a capital point of view, but given the passage of time, there is more potential for income to grow through time, and hence, with that passage of time, eventually that income component from Aussie equities will far outweigh what's going to be delivered from term deposits.
Yeah, it's a really interesting point, especially, volatility around interest income, from cash is not something that people usually talk about a lot. But I suppose, comparing it to equities over the longer term, that's really understandable points. That's interesting. But taking a step further in terms of the market conditions that I suppose all investors are facing at the moment, how are you making investment decisions as part of the fund in light of what's going on in the market at the moment?
Good question. I think our process really doesn't change under different market circumstances. We're always looking for companies where they are disconnected from their fundamentals. But in light of the increased volatility that we've seen, is actually good for us. First of all, our low beta strategy always protects capital versus what's going on with the market. But more importantly, it actually throws up more opportunities, because obviously with volatility comes, these disconnects, right? And it's up to astute fund managers to actually work out whether, it's a worthwhile, risk return opportunity to take advantage of these opportunities. And I sort of highlighted QBE, 6 months ago it was James Hardie, and I want to find more of these opportunities.
Yeah. Is there sectors or parts of the market where you're seeing this dislocation play out more than other parts?
Yeah, look, I mean, it just depends.
Yeah.
You know, I think when you sort of look at the market, it just, at any point in time, there are certain thematics that's going on. So obviously rising rates is putting a lot of pressure on, you know, what we call bond proxies, you know, companies with very stable cash flows. So they look a little bit interesting, but it may not be time to buy these types of stocks, because especially when rates continue to rise. You know, I think what we like to be positioned, so for example, such as QBE, where it's on the PE of 10, you know, with a tailwind of rising rates, the market is not, you know, factoring in, you know, a solid earnings profile for this company. So, you know, it's about identifying these opportunities on a risk-reward basis, and you know, obviously staying away from companies that could potential crash from an earnings perspective, and obviously companies that are still influenced by, you know, discount rate issues.
That's great. And then how can investors access the fund itself?
So the fund is available on most platforms, you know, and you know, or alternatively, investors can invest directly into the fund. The minimum investment into the fund is about $20,000, but it is available across, you know, across the market.
Jason, thank you for your time. Really appreciate it. Great update, and we'll speak to you soon. Thank you.
Thank you for having me.
Appreciate it. To find out more about the Vertium Equity Income Fund, please visit vertium.com.au for more information. If you have any questions about the fund, please call us on 1300 052 054 or email invest@associateglobal.com. Thanks for your time.